Topical Tuesday today, and today I'm speaking again about the economy, about the world, trade, and everything that's going on in the world. Two topical matters. One, the uncertainty which is coming mainly from Trump, in all fairness, the tariffs, and now what's going on with the war negotiations between Ukraine and Russia, the fact that the US is getting heavily involved. They appear to be putting some quite unfair terms on Ukraine in terms of taking their resources in order for them to act as peacemakers and protect them. And also in terms of them not even letting Ukraine be part of the discussions. Most of the European leaders have met up recently to see what they can do, but it looks like there are going to be serious negotiations and discussions between Trump and Putin, which could cause an end to the war. But what does that mean for everything else? You also have a lot of other uncertainty about the markets and about what these tariffs are going to do. People are scared at the moment. My personal view is that you shouldn't be. There is always something going on in the world. If you look at the media, look at news, you always find something being talked about in a negative fashion or a negative manner. My advice is try and shut out all of the noise and just focus on your plan. Do what you can do. Do what you can with what you have where you are, so to speak. So focus on yourself, do what you can do to improve your situation and plan for your financial future. And that's what this video is about today. In particular, the amount of people leaving the UK to go overseas, whether that be the UAE or the US, which are the two main markets that people are going to at the moment. For people who do move to the UAE or other Middle East countries, this video is designed to explain what a UK expat should do when it comes to investing, and is to give my 4 or 5 top tips on how or what they should be investing in and why. So first and foremost, when you're in the UK, there are 2 very good things that the UK has going for it when it comes to retirement planning. One is that by default in the UK tax system, you pay taxes, you pay national insurances. Now, when you pay those national insurance contributions, each year you get what they call a state pension credit. So you're building up a retirement plan without even realising it, first and foremost with the UK state pension. Now, this isn't typically enough to live on and survive in retirement, but it's a very, very good start and you don't have to think about it. The second thing is when you're working, in the UK, they now have something called auto-enrolment, which means unless you opt out, you will automatically be enrolled into a private pension as well. Now that private pension essentially gives you around 8% of your salary each year, and it's invested, so that builds over time. You would hope, assuming that it's invested correctly. That 8%, it comes from 3% from your salary, 4% from your employer, and 1%, which is essentially tax relief, so I guess you could say from the government. They're both done automatically, and you don't really have much to do to make sure it happens. It just happens in the background for you. When you move to the UAE or any other Middle Eastern country or the GCC, you don't have these measures in place. You don't have a pension system. And the reason for that is because in the UK, they have ISAs, they have pensions, they have VCTs, EISs, SEISs, and so on. All of these different investment wrappers or types of investing have tax benefits or tax efficiencies. Let's take an ISA, for instance. You pay tax on what you put into that ISA first, but then once it's in the ISA, it grows tax-free. And then you can take it out tax-free as well. A pension, you can't take it out tax-free, but when you put it in, you get tax relief on what you've put in. So rather than paying tax on your income in the year, if you put it in your pension, you don't pay tax on it. So it allows it to go in at a higher amount and you invest more initially, and then it grows over time tax-free until the point that you take it out. But when you take it out, it's subject to your marginal rate of income tax. VCTs, EISs, SEISs that I mentioned, these are all other tax efficient ways of investing. The only reason they're pertinent or relevant in the UK is because there is a tax system. It's the tax system which makes them efficient. If you're in the UAE, those taxes, the capital gains tax, the income tax, they're not there anyway. So for instance, just holding a normal general investment account or being invested in stocks and shares in the UAE is exactly the same as an ISA, because you're not going to pay any capital gains tax whilst you're living overseas. When it comes to a pension, pensions are a little bit more beneficial because you do get employer contribution as well, sort of an employer match. Like I said, that 4% employer match, which is an additional benefit. So they're slightly more beneficial because of that. But in terms of tax properties, i.e. not paying income tax, you're not paying income tax anyway, and it's growing tax-free anyway. And out here, when you take the money out of your investment, provided you do it before you return to a taxable jurisdiction, again, you can take it out tax-free. So you have all the benefits out here of everything you could sort of have in the UK anyway. So that's what I wanted to mention, the importance of investing out here. The hard thing though, you have to take that initiative and you have to do it yourself. It's not something which you're automatically going to be enrolled into, with the exception of the gratuity scheme in the UAE, which is something to do with what you earn when you finish your job. You get a payment based on how long you've worked and based on what your basic salary was at the end. Now, one thing to caveat on that is that it is based on your basic salary. So if your income package is made up of 40% basic salary, 50% allowances, 10% other bonuses or anything like that, it's not necessarily all going to form part of that gratuity. And that's why it's nowhere near as beneficial as, say, a UK pension, where you're getting a lot more put into it, at least 8% per year. And that's why it's really important that you do invest yourself. That gratuity is not going to be enough for you to live on in retirement. So with that in mind, I want to give you my sort of top 5 investments as a UK expat, and in particular in a tax-free jurisdiction like the UAE. Just to caveat this, all of these investments should be done correctly. My advice is you take proper financial advice and guidance, whether it's professional or whether it's reading, doing research and understanding what you should be doing before you make investments. Because for me, there are steps to go through first. First, you should build a very good grounding, have your emergency fund, have your insurances, have your LPAs, POAs, wills, and so on in place before you start investing. But that's just me as a financial planner, a financial advisor, what I believe. But bear that in mind before you go jumping in with any sort of investments. This is not investment advice, this is just information on different products and types of investments. Like I said, in the UK, they have a state pension. If you are a UK expat, or if you've lived in the UK for at least 3 years paying national insurance, you are eligible to make what they call voluntary contributions. So you can still pay into the UK state pension as a non-UK resident. Now, those contribution rates, there's either class 2 or class 3. Class 2 is around £180 for the year to get the contribution, and class 3 is more like £900, £920 for the year. So it may seem like a lot of money, but the benefit that you're going to get from it is exceptional, and it's very unlikely, no matter what anyone else offers you or says to you, it's very unlikely that you will get a better investment opportunity. So I would always advise everyone who moves overseas to ensure that they are maximising their UK state pension and they get as close to the 35 years of qualifying contributions which are needed to get the maximum UK state pension. If you do want further help or guidance on that, it is something that we can help you with, but there's also a lot of great information on the HMRC website. The first step would be for you to obtain something called a state pension forecast from the Government Gateway portal. If you do that, you should then be able to follow it through into the next steps of doing the online applications or the paper-based application, depending on when you're filling it in and what the rules are at the time. So that's my number 1 tip for a UK expat. Ensure you obtain the UK state pension or eligibility to it by making voluntary contributions. Number 2, the next thing is just a very plain, vanilla, simple general investment account. Now that's essentially an account similar to a bank account, but it allows you to hold stocks, shares, funds, ETFs, anything you want in there. Most of them are open architecture and allow you to hold anything that is on a stock market, and they have a lot of extras in there too. Now you can have these which you manage yourself, or you can have them which your advisor, financial advisor, manages for you. For me, this is the cheapest and most efficient way of investing and saving, but it does require an element of accountability by yourself, because you have to make sure that you transfer into it on a regular basis and you are saving and investing. But they are by far one of the best methods of investing. The only thing to really consider when it comes to general investment accounts for me is diversification and your time horizon for investment, i.e. how long you're planning on investing. The reason diversification is really important is because when it comes to investing, there are two main broad categories of risk. You have systemic risk and unsystemic risk. One of them can be eliminated altogether without changing the returns that you're likely to get. That is unsystemic risk. So let me just give you a very brief breakdown of what each one is. Systemic risk is also known as market risk, and this is essentially the risk of an entire market or an entire asset class failing or falling in value. Now that may be because of a recession, because of interest rates falling, because of inflation, because of politics, etc. This is the type of risk that you can't really do anything about because it's going to affect everyone. It's going to affect the whole market. You then have something called unsystemic risk, or other names for it are specific risk or idiosyncratic risk. They're the other two terms that you may hear it go by. With this risk, it focuses more on companies or specific industries and eliminating the risk that they hold. What I mean by that is, if you just hold investments in a specific company, well, you may have something called management risk with that, or management failure. So if there's a bad decision, they could fail. Maybe that company goes bankrupt. And you can eliminate that risk to a certain extent by diversification. The other side of it is industry risk. You can have sort of regulatory changes which causes an industry downturn. So those are the types of risks which you can mitigate by getting rid of. Now that involves diversifying into a lot of different industries, a lot of different companies, different types of asset classes, so that you get rid of that risk. And just to give you a very, very, very basic example of what I mean by that. Let's say you have a shop in the UK and they're in a holiday destination, a caravan site or something like that. Now, if they were to just sell one product, say ice creams, that's great. When it's hot, people are going to go and buy the ice creams. But when it's rainy, they're not going to have any sales, and that's a big risk. Now, they can diversify to reduce that risk so that no matter what happens, they're making something. So now let's say they sell two products, ice creams and umbrellas. Now, when it's sunny, people are going to go and buy the ice creams. And when it's rainy, people are going to go and buy the umbrellas, which is great. They've diversified their risk and they've got rid of the unsystemic risk by diversifying. When it comes to systemic risk, even if they have both of those products, if there's a recession or if there's high inflation or if there's a regulatory change, which means that people are on curfews and they're not allowed out of the house, all of those things, no matter how many items they have, how much they've diversified, everyone is in the same situation and they can't buy anything anyway. So if there's a recession, people have got a lot less money and they can't afford the ice cream or the umbrella. If there's inflation, maybe they're too expensive. If there's regulatory types of curfews or anything like that, well, maybe they're just not allowed out. So again, they can't buy anything. So that's the difference between the two types of risks and why diversification is really important. However, that's diversification against asset class, against time horizon for investment, against industry, whatever it may be, it's really important that you diversify, and that's where a financial advisor again should add value and ensure that you have the correct portfolio of investments for you. I spoke about time horizon for investment. The reason I always mention this is because when you need to take that money out is super important. If you need to access those funds, let's say you're buying a house with 50% of the value that you have in your general investment account in 2 years' time because you're returning to the UK. Well, you don't want that 50% of your value to be invested in the stock market or an ETF or a fund, which could go up or could go down. Because if it goes down over the next year or two, you have to crystallize that loss. You need to take that money out. You're crystallizing that loss and you're putting it elsewhere. Whereas if you have that 50% into a fixed income, a fixed return type investment, which is just giving you, say, a flat interest rate, you know that you have that full capital there in 1 year or 2 years' time to take out and buy that house. If you're investing for the long term, say 10, 20 years, typically being invested in the stock market is going to return you a higher yield than the fixed income type returns. So in that case, you would want to be invested in the stock market, in funds, ETFs. But it's really important that you establish what your time horizon for investment is for each expense and you invest accordingly. So that covers my general investment accounts and why you should use them, but what you need to look out for. The next one, number 3, is tax wrappers. So even though you are in a tax-free jurisdiction now, it may not be the case later down the line. Maybe you're planning on retiring in the UK or in Europe or in another jurisdiction which taxes you quite heavily. There are certain wrappers, typically they're called life insurance investment wrappers or portfolio bonds, you may have heard them called. These offer tax efficiencies when you go back to the UK later down the line. Now, the tax rules around this comes from the Income Tax, Trading and Other Income Act of 2000, and I've noted down the sections for you here, sections 463, 507, 528 and 535. I'd say the main ones which cover some of the benefits that these types of investments offer. Now, they're usually offered by companies based in the Channel Islands, so they do have a relatively high degree of regulatory control, so they're quite safe. But like all investments, there is an element of risk because you're usually invested in a stock market similar to a general investment account. The main thing to consider for these is they're tax efficient when you go back to this jurisdiction. So how long you hold them outside of that jurisdiction is really important. So if you're holding it for say a 20-year period whilst you're resident in the UAE and then you're going back to the UK, one of the benefits is something called time apportionment relief, which means that all of the gains which you make on this investment, if you're in the UK, it'll be subject to capital gains tax once you become resident again. If you're in the UK and you hold one of these assets, that gain that you've accrued over time is apportioned based on the amount of time that the asset has been held in the UK versus the amount of time it was held overseas. So if you've had it for 20 years in the UAE and 10 years in the UK, you're going to pay 10 out of 30, i.e. 1/3 of the usual tax rate. Now, that being said, the way these investment products are taxed is very different to a normal investment. They're taxed at marginal rates of income tax rather than capital gains tax. So capital gains tax rates in the UK are 18 or 24%, whereas income tax rates are 20, 40 or 45%. So it's not always necessarily the case that even with the time apportionment relief, it's going to be more beneficial, but in some instances it is. The top slicing relief can also be beneficial. If you have other sources of income in your retirement which push you into the higher rates or additional rates of tax, then this benefit isn't really there, but in some instances it can be. Now, you may often hear this explained as a benefit, which is the ability to take back 5% of what you've invested each year for 20 years without any tax implications in the UK. It's not particularly a benefit because usually you can take back what you've invested with no tax implications no matter what. It's a feature, but that feature allows you to get the positive features, which are the tax efficiencies. So these wrappers, they can be very useful, they can be very, very good. The main benefit that they bring is once you're in the UK, the growth on the assets within that bond or within those investments is deferred. So it's something to consider, but you do really need to look at the tax implications of when you go back to the UK. And this is something I focus on heavily with my clients. We do more of a tax qualified, tax trained report showing what their annual tax returns will look like. And for me, that's really important when it comes to these types of investments. But they can be super beneficial for some people. My next type of investment, or the fourth type of investment wrapper that I recommend for people who are expats, is to look at a family investment company. Now, this is a UK investment company usually, however you can open investment companies offshore as well, say in the UAE or other jurisdictions. But for me, the main two benefits of a family investment company are around inheritance tax and wealth building, or taxes on wealth building. If you're someone who likes UK property, then when you own that UK property, no matter where you are in the world, you will still pay income tax on that property, and you will still be subject to inheritance tax on that property. Inheritance tax in the UK is very high, it's 40%. You get a nil rate band, which is £325,000 per person, but that nil rate band allowance has not changed in over 15 years. And in that same period of time, house prices have almost doubled. So you can see that a lot more people are being brought inside the scope of inheritance tax, and it's becoming much, much, much more of an issue. So family investment companies, particularly in the UK for UK property, are very good and helpful for mitigating inheritance tax. And they can also be good for income tax purposes. If your plan is to build a portfolio of properties, or you have very high value properties which yield a very high income, if you're doing this to build for your retirement purposes, let's say you're building up a portfolio over a 20-year period, if the income that you're generating is say £100,000 a year and you're just going to reinvest that into buying new properties, this is where one of these types of structures can really pay dividends. The marginal rate of income taxes, as we've said in the UK, are 20, 40 and 45%. If it's held within a company, you just pay corporate tax of 25%. So typically what would happen is, rather than paying 45% income tax and then reinvesting that money into property, you would have the properties held in the company. You would only pay the 25% corporate tax and then reinvest that money into more properties and let it build. So it allows you to build your wealth and build your portfolio much quicker if that is your long-term plan. There are caveats with this. There are things to be cognizant of. In particular, stamp duties on buying properties can be higher if you buy them in a company, especially if you're overseas resident, you pay an additional amount for that as well. Also, if you're getting mortgages on those properties, typically a company would pay maybe 1 or 2% more as a mortgage cost than an individual. So there are things to be careful of. But family investment companies can be extremely beneficial for people going back to the UK with high asset values and investment values of maybe £1-2 million, or people who are planning on building a portfolio. And again, they're good for mitigating inheritance tax and passing assets and value down to your next generation efficiently. That brings me on to my fifth point for investments for UK expats, and that is property. I do believe in property. A lot of investment advisors may say that they recommend you focus more on the stocks and funds, and like I said, I believe in diversification, and property is a good element of diversification. Now, I have my own views and opinions on where that property should be located or what is best for retirement planning, and I'll give you a bit of them, but bear in mind, these are my opinions. This is not advice. This is not me being a property specialist. This is my opinion based on what I've seen and what I think. So first and foremost, when it comes to property, if you're living in a country like the UAE, rental as a percent of the property values tends to be higher than it is in the UK. So what you would maybe call your yield in the UAE, for instance, is maybe 10% a year. So you're paying 10% of the property value to live in it each year. Whereas in the UK, that may be more like 5-6%. My view is that if you're planning on living in the UAE or somewhere like that for a 5 to 8 year period, buying as early as possible, knowing that you're going to be there for that long, is beneficial. The reason for that is because even if house prices fall over, say, an 8 year period, well, they would need to fall by 80% of the property value based on the fact that you would have been paying 10% of the property value in rent anyway. So for me, buying for a long-term stay in the UAE is a very good idea. If you're not planning on staying for more than, say, 5 years, my personal view is that buying in the UAE or most of the Middle East is quite a risky investment. It can be a higher return investment, but if it's retirement planning, I think it's too risky to be buying in the UAE for investment purposes. The reason I say that, and again, I do need to caveat, I am not a property specialist, this is just my views. The reason I say that is because in the UK, if you buy property there, there's a very, very long history in terms of property in the UK. We know what the property market looks like, how it goes up and down, but how it almost always goes up over the long term. And that's mainly for two reasons. One is because of supply and demand. There is always a lot more demand than supply in the UK. There's a huge shortage. And two, there isn't that much space to continue building in the UK. So finding land that you can build on is quite difficult. So land and properties are at a premium. When it comes to the UAE or most other Middle East countries, there is still a vast amount of land to build on because they're relatively new. So there are properties popping up constantly. The UAE has had a massive influx of people over the last few years, which has caused house prices to skyrocket. In the short term, that's a very good investment. My view is that it is much easier for A, the amount of people coming to the country to decline, and B, the amount of properties being built to increase, which is happening. Now, the more you have supply, the less demand, and it causes your prices to fall. So ultimately, I think the risk of the property prices falling is much higher in the UAE at the moment. And that's why my advice to most of my clients is that if you're investing for your retirement, invest in UK property because it's stable and it's going to very likely continue to increase over the long term. If you're being speculative, then yes, UAE property is good because you're likely in the short term to get higher returns. But you also have that volatility whereby it could fall a lot more as well. So that's my advice when it comes to property. A bonus investment, I guess, just to throw in at the end, is yourself. Invest in your skills. Everything that you earn in your career is down to you. Your biggest asset is you as an individual. It's not property, it's not a stock, it's not a share, it's you as an individual. The more skills you have, the higher income you can command or the higher income you can generate, the better. So my sixth and final tip is invest in your skills, invest in your future, and invest in yourself. Now, I hope that has given you food for thought and you all enjoyed the video. You all have a good idea of what sort of investments you should be looking into. If you do want to discuss any of the potential investments which I mentioned in my video in more detail, I am in the UAE, so I do meet a lot of my clients over here, and I can also connect with people via Teams. If you did enjoy the video, do please like, subscribe to the YouTube channel, share, and I will look forward to seeing you at the next one. Bye-bye.